studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
The tax on split income rules are often viewed as restrictions, but it is equally important to understand that they also include a number of exclusions. These exclusions recognize that many family members make genuine contributions to owner-managed businesses and should not automatically be subject to the TOSI rules. When a corporation pays a dividend to a related family member, TOSI does not automatically apply. Instead, the next question is whether the recipient qualifies for one of the available exclusions. If a valid exclusion applies, the dividend continues to be taxed under the normal dividend tax rules rather than at the highest marginal tax rate. So why do these exclusions exist? The main purpose is to distinguish legitimate family business arrangements from artificial income splitting. Many owner-managed businesses rely on the contributions of spouses, children, and other family members. These contributions may involve working in the business, helping manage operations, investing capital, or participating in the long-term growth of the company. The tax system recognizes these genuine contributions and provides exclusions so that legitimate business families are not unfairly affected by the anti-avoidance rules. There are several common categories of TOSI exclusions. One of the most important is active involvement in the business. Family members who regularly work in the corporation may qualify for normal dividend taxation. Another common exclusion applies where an individual has made a significant labor contribution, providing valuable skills or management services to the business. In some situations, a significant capital contribution may also support an exclusion. In addition, Canadian tax law contains certain age-based and ownership-based exclusions that may apply in specific circumstances. The important point is that these exclusions are based on real economic involvement, not simply family relationships. Being a spouse, child, or other relative is not enough by itself. The recipient must satisfy the requirements of an applicable exclusion before the dividend can continue to receive normal tax treatment. A simple way to think about the process is to follow 4 steps. First, the corporation pays a dividend. Second, determine whether the recipient is a related person. Third, determine whether a TOSI exclusion applies. If the answer is yes, the dividend is taxed under the normal dividend rules. If not, the TOSI rules may apply. The key takeaway is that TOSI is not intended to penalize genuine family businesses. Instead, it is designed to prevent inappropriate income splitting while still allowing normal dividend taxation when family members make meaningful contributions to the corporation. Understanding these exclusions helps owner-managers plan dividends appropriately while remaining compliant with Canadian tax law. The TOSI rules contain many technical exceptions, but in practice, most owner-managed businesses focus on a few common exclusions. These exclusions are designed to recognize family members who have made a genuine contribution to the business, allowing dividends to continue being taxed under the normal dividend tax rules instead of the TOSI rules. One of the most common exclusions applies when a family member works regularly in the business. If an individual is actively employed by the corporation and performs meaningful work on an ongoing basis, they may qualify for normal dividend taxation. The key idea is that their involvement is real and continuous, rather than occasional or purely for tax planning purposes. Another important exclusion involves a meaningful labor contribution. Some family members may not work full-time, but they contribute valuable skills, management expertise, or professional services that are important to the success of the business. Their contribution goes beyond simply being listed as a shareholder. Instead, they actively help the business operate and grow. A third category involves significant capital contributions. In some situations, a family member invests substantial capital into the corporation and bears genuine financial risk. Because they have invested their own money and contributed to the business financially, the tax system may recognize that contribution through one of the available TOSI exclusions. There are also certain ownership-based and age-based exclusions. These rules are more technical and depend on the specific facts of each situation, including the individual's ownership interest, age, and the nature of the business. While you do not need to memorize every technical requirement at this stage, it is important to recognize that these exclusions exist and are commonly considered during corporate tax planning. Notice that all of these exclusions have one common theme. They are based on genuine participation in the business, not simply family relationships. Being a spouse, son, daughter, or other relative does not automatically qualify someone for an exclusion. The tax system looks for real involvement through labor, management, capital investment, ownership, or other recognized criteria. Whenever a corporation pays a dividend to a related family member, the process should always begin by asking whether a valid exclusion applies. If it does, the dividend is generally taxed under the normal dividend rules. If not, the TOSI rules may apply instead. One final practical point is documentation. Whenever a corporation relies on a TOSI exclusion, it is important to maintain supporting records. Employment records, shareholder agreements, evidence of capital contributions, management responsibilities, and other documentation can help demonstrate why an exclusion applies if the Canada Revenue Agency ever reviews the corporation's tax filings. The key takeaway is that TOSI exclusions are intended to recognize genuine contributions to owner-managed businesses. Family members who meaningfully contribute through work, management, capital investment, or qualifying ownership may continue to receive dividends under the normal tax rules. Good tax planning is not just about understanding the exclusions, it is also about properly documenting why those exclusions apply. This final checklist brings together everything we've learned about the tax on split income rules. Rather than trying to memorize every detailed provision of the Income Tax Act, tax professionals often use a simple series of questions whenever a corporation plans to pay dividends to a family member. The first question is, who is receiving the dividend? If the recipient is not a related individual, the TOSI rules will generally not be relevant. However, if the dividend is being paid to a spouse, child, or another related family member, the analysis continues. The next question is whether the dividend has the potential to fall within the TOSI rules. If the answer is yes, the most important step is determining whether one of the available TOSI exclusions applies. This is where the facts become critical. Does the recipient actively work in the business? Have they contributed meaningful labor, management expertise, or capital? Do they satisfy one of the ownership-based or age-based exclusions? These questions help determine whether the dividend qualifies for the normal dividend tax rules. If a valid exclusion applies, the dividend can generally be taxed under the normal dividend taxation system. If no exclusion applies, the dividend may instead be subject to the tax on split income rules and taxed at the highest marginal personal tax rate, eliminating most of the intended income splitting benefit. An equally important part of the process is documentation. Good tax planning is supported by good records, employment agreements, payroll records, timesheets, shareholder registers, evidence of capital investments, management responsibilities, and other supporting documents can all help demonstrate why a TOSI exclusion applies. If the Canada Revenue Agency reviews the corporation's tax filings, this documentation may be essential in supporting the corporation's position. As tax professionals, We should also remember that TOSI is not intended to prevent legitimate family businesses from operating efficiently. Instead, it is designed to distinguish between genuine business participation and arrangements created primarily to reduce taxes. Careful planning and proper documentation allow owner-managed businesses to comply with the law while still taking advantage of the available exclusions. Looking at the final comparison, the difference is straightforward. When a valid exclusion applies, dividends continue to be taxed under the normal dividend rules and represent legitimate tax planning. When no exclusion applies, the anti-avoidance provisions take effect, and the dividend may be taxed at the highest marginal rate. The key takeaway from this entire topic is that TOSI should always be evaluated before paying dividends to related family members. A simple checklist can guide the analysis. Identify the recipient, determine whether TOSI could apply, evaluate the available exclusions, and document the supporting facts. Following this structured approach helps ensure that dividends are both tax efficient and fully compliant with Canadian tax law.